the entire private market, 90% of advisors are just ignoring, because that 60-40 stock and bond portfolio is so easy and highly profitable for them to implement. So most financial advisors, they focus on wealth management, traditional kind of boring 60-40 portfolios, 60% stocks, 40% bonds. And they're really built to be more like McDonald's. They want to crank out these plans. They want to give everybody the same type of advice. And it's really, they're geared towards, somebody with 1, maybe 2 million of net worth and a very simple lifestyle. Whereas we tend to focus more on complicated portfolios, business owners. They have more tax complexity. They want to have more income from their portfolios. And so we broaden out the type of investments that we will work with these clients to include real estate debt, private credit, in addition to stocks. Yeah, the traditional financial advisor that is charging you 1.5% assets under management is a tough model. Over time, they end up taking a disproportionate amount relative to the advice and the value that they're actually giving their clients. Because that 1.5%, or sometimes it's 1%, over 30 years is actually a substantial amount of money. And if they are just putting you into ETFs, right, that is just a portfolio of stocks and maybe some bonds, there's not really much alpha they're giving you. There's not a lot of tax advice. There's not a lot of value that they're giving you that you couldn't just do yourself with just a simple ETF portfolio. And so over time, that amount of money adds up. Maybe when you're worth $1 million, that 1%, that $10,000 doesn't feel too crazy. But what happens over 30 years? That $10,000 just keeps adding and increasing over time as the stock market rises. And the financial advisor is not doing anything different for year 20 when they're now making $30,000 or higher. They're doing their same level of service as they were that day one. And so I think that the traditional just charge everybody 1% and put them in ETFs and some bonds is not fair to the individual client. Well, number one, we tend to focus more on business owners, entrepreneurs, doctors, lawyers, people that are generating pretty high incomes and have just an entrepreneurial mindset. Maybe they're not a business owner today. Maybe that's something they're planning in the future, but they view themselves as a builder and they just have bigger ambitions. They're not trying to watch their clock to when they're going to retire and sit around and play golf all day. They have big ambitions for their life in retirement. That might be work optional, where they can work on projects, they can work on their charities. And so we tend to fit really well with that client base because I'm an entrepreneur and I like to think about growing our business and growing our investment portfolios and not just sitting around and collecting or selling stocks to fund a retirement and trying to figure out how long do we have to make this retirement last. The vast majority of financial advisors get paid an assets under management fee, where it's a 1% or maybe 1.5% of your total portfolio value that they're charging you each year. And so as the stock market naturally increases, call it 9% compounded over time, they're getting a 9% raise every year forever, right? And so they usually are not adding a lot of additional services, even though their revenue over time is compounding. Another version is just a flat fee, where they might say, hey, each year we're going to give you financial advice, or we're going to manage your investments, and you're going to pay us $10,000, maybe $25,000 at the maximum, a flat fee type of service. That's okay for some, but most don't like writing that $10,000, $25,000 check each year and then going off and implementing all of the advice on their own. Most people, if they hire a financial advisor, they hire an investment manager because they actually don't want to get in the weeds on selecting the investments or dealing with tax strategy. They want somebody to actually execute the plan. So those are the two major fee structures in the industry. The overwhelming majority of people focus on AUM, which AUM, in a lot of ways is pretty well aligned with the client, right? You want the client to do well. You want their assets to grow over time because then your fee revenue stream as the advisor is growing with them. The problem really isn't that structure. It is the fact that it's uncapped, right? So if it's uncapped, you can literally start out at $10,000 a year, 1% on $1 million portfolio, and then compounding over time, you could get that person to a $10 million portfolio. And then all of a sudden the advisor is getting $100,000 per year. And yet they're doing the same things that they were doing in the first year. And the market did most of that heavy lifting if they are in a very vanilla 60-40 type of portfolio that might be comprised of a few ETFs. So I personally think that is the problem with the industry, is the fact that these fees are uncapped. They can just compound and grow to the sky. Whereas Evergreen Capital set it up where the fees are capped. Once you're getting past roughly $6 million of net worth, the fees are capped and they're not growing exponentially. They're not continuing to grow to the sky regardless of the amount of effort and the amount of services that you're receiving as the client. The hidden fees in this industry usually are around some sort of commission if the advisor is not a fiduciary, and a fiduciary means they have to look out for your best interest as if it was their own money. Or maybe the advisor's putting the clients into mutual funds. The mutual funds have oftentimes what's called a load, which is a commission to the mutual fund provider. I think most of the industry has now graduated to ETFs, which are a much cleaner form of investment management. But yeah, there can be some hidden arrangements with advisors that are not fiduciaries. They might be broker dealers that are getting paid for some of the products that they are recommending and putting their clients into. So you definitely want to make sure that whoever you're working with is a fiduciary. They have your best interest in mind and don't have any conflicts. Well, you can just walk through your portfolio, what they have you in, just to make sure that there's not some underlying fees on the individual investments that they've recommended to you. And so anytime you're having your quarterly or yearly meeting with your advisor, you can have them walk through that and ask that specific question. What are the underlying fees for each of these investments? And then you could also ask them, are you a fiduciary? Are you a investment advisor? Or are you a broker dealer? Because it's often not clear. You can have a broker dealer who is paid commissions for the products and oftentimes insurance products that they're selling to their clients that look and feel like a registered investment advisor. Whereas a registered investment advisor is a fiduciary. They have a lot of regulatory requirements to make sure that they are doing the best things for the clients at all time and have to disclose any conflicts. It would just be if they were putting you in these mutual funds that have the higher fees than an ETF. But for the most part, if you're working with a fiduciary, you're probably going to be in pretty good shape. You just want to make sure you're not in a lot of very high fee mutual funds, because that was the industry 30 years ago, 20 years ago. There has since been innovations in the space that are much more tax efficient, and they have much lower fees. And so I would argue that if you're in a bunch of mutual funds, you're working with an advisor that has kind of stayed in the past. You need somebody that's a little bit more forward thinking and has designed a portfolio that's more efficient and has fewer fees. Yeah, I think a lot of advisors are still designing portfolios that worked really well in the last regimen, in the last cycle, when 60% stocks and 40% bonds worked incredibly well together. Because over the last 30 years, we've had a market environment where interest rates have slowly been declining, and interest rates and bonds did a great job hedging your portfolio. In other words, when the stock market was having a crash or was down, your bond portfolio would go up. It would counterbalance your stock portfolio, which was fantastic, right? Because then you could get kind of a 7-8% blended return without a lot of volatility, right? Your stocks are crashing, but your bonds are going up, right? Those are uncorrelated returns. That's great. It smooths the ride, which a lot of retail investors need. They just cannot emotionally handle 30% down markets. Like the GFC, when in 2008, when the market's crashing 30+%, a lot of people panicked. They fire sold their assets because they just can't handle the idea that their net worth, their whole retirement is just tanking right on a screen in front of them. And so bonds did a great job of offsetting that. The problem with that today is we have just insane amount of debts at the government level. And we are in more of an inflationary environment. And the government continues to print more and more money. And therefore, bonds are not working like they used to. Bonds are not offsetting stocks when stocks are declining. In 2022, we had stock markets was down substantially. The bond market was down substantially. So the bonds weren't zigging when stocks were zagging, so to speak, right? So the correlations went to 1. In other words, they all did the same thing. And therefore, you have nothing really to offset your stock portfolio. And so now that 40% is getting a paltry 4% return, and it's not doing any benefits to offset your stocks when the market's tanking. So what we do differently is we add private investments, we add real estate debt, contractual payments that can offer higher coupons, higher yields, offer the same, non-correlated return streams that bonds used to provide in portfolios, and they generate just a lot more income for clients, and that tends to lead to better outcomes today versus just a vanilla 60/40 stock portfolio, at least in our view. Most financial advisors offer clients this basic portfolio, 60/40 stocks bonds, because it's extremely easy for them to implement. It's very easy for them to explain. It's very easy for them to execute the trades every month to rebalance portfolios. It keeps their business highly profitable and highly repeatable. They don't have to go research private investments, higher return opportunities. They don't have to do the due diligence on those opportunities. And so you have this giant set of available investments, the private market, which is becoming more and more important as the number of stocks keep declining in the public market, because it's harder and harder to be a public company. And so the entire private market, 85%, 90% of advisors are just ignoring, because that 60/40 stock and bond portfolio is so easy and highly profitable for them to implement. And they can just do it over and over on rinse repeat for as many clients as possible without having to give a lot of custom investment management advice. So just think about it from their standpoint, their business. The easier it is to implement these things, these portfolios, the easier it is for them to hire people to work with new clients to explain that. The fewer variables that they have in their business means their business is more profitable, because they can come up with a very systemized plan that anybody can replicate with just a little training. Anybody can explain it. To get good at private markets, to get efficient and be a professional at alternative investments, you got to go really deep in the weed. We're talking private credit, private equity. You got to know things about venture capital, debt, hedge funds. It gets very complex, and you have to know a fair amount about all of those products if you have a more sophisticated client that wants to have exposure to these asset classes. And that's not as simple as typing in a couple of things on a computer and making the trades in a 60/40 portfolio that, once again, a lot of people can do. If you're going to have a robust offering on the private side, you have to do a lot of due diligence on the strategies, a lot of due diligence on the managers, on the underlying funds. And so it just takes a little bit more sophistication that not every financial planner can replicate. We talked a little bit about the AUM model and the fact that it is uncapped. That is a conflict, because the simpler you keep the portfolio, if you can keep your level of service the same with a client and the market keeps going higher, the advisor is going to get more and more profitable off that client without having to do any more additional work. So that is a bit of a conflict. You want the advisor to be delivering the highest level of service. You want them offering unique investment strategies to improve the outcomes for the clients, and not be just focused on how profitable can we get, and we'll let the market do the growth for our fees. So that's a bit of a conflict if the fees are not capped. A second conflict is, we talked about the 60/40 portfolio, and if a particular client brings an opportunity in the private market to an advisor, the incentive for a traditional vanilla 60/40 portfolio advisor is to say, no, that's too complicated, because they're very used to their simple and very easy to implement program. If the client is bringing them an opportunity that they would like to invest in, they want the advisor's opinion, almost all the time, the vast majority of the time, the advisor is going to say, that's too complicated, let's just stick with the plan. Because what's their incentive to have you invest in this real estate project? They don't know that much about real estate. Perhaps they've never invested in real estate themselves. And it just adds complexity to incorporate that reporting and that real estate investment with their financial statements at Charles Schwab or Fidelity. First and foremost, if somebody is recommending a strategy and you don't know if they are getting a commission off of it, that's square one. Figure out, are they a broker dealer? Are they incentivized per product, per investment? If they say, no, I'm not a broker dealer, we are a fiduciary, we're a registered investment advisor, you can feel a lot more comfortable in that what they are recommending is in your best interest. Because the advisor, anything that they are recommending, regardless if it's Fund A, Fund B, or cash, should be getting the same incentive, the same fee. So that's square one. The reality is that if an advisor who is a fiduciary is recommending a private fund, that they can't just, click a few buttons on their computer and trade for you and buy for you, then they are adding complexity to their business. They are adding steps in the process to get you signed up for that private fund, to include it in the reporting, to do the due diligence on that private fund. So they are adding layers of overhead to their business. And so just intuitively, they're probably doing that for the right reasons because they think it's in your best interest, it's going to improve your returns, and that's the best. I'm not sure I understand. Whereas, once again, an ETF portfolio or just stocks and bonds is going to be more profitable because they don't have any of those layers. They don't have any of that complexity. So just by default, I think you can feel good about that from a fiduciary offering or recommending something that may be a little bit off the beaten path versus just a boring vanilla ETF. I'm a big fan of, if you feel like you're getting great service and you're comfortable with your plan, with your advisor, by all means, stay the course. If you have kind of an inkling that you're not getting enough value, then you should be diving into a couple of these questions. What is their viewpoint on the market on a go-forward basis? If you are in stocks, if you are in just ETFs and bonds, what is the advisor's view on bonds given what we've talked about with our national debt crisis? Do they think that bonds are going to offer the same amount of protection as they had in prior years? Does the investment plan really achieve the goals that you're hoping for in your financial for your retirement? Are you okay with this idea of selling down your stocks as you go to fund your retirement? Are you okay with taking withdrawal risk in the early years of your retirement? What happens if the stock market's down the first couple of years? That's called sequence of return risk. And not a lot of people that we've found are really comfortable with that. They don't like the idea, especially entrepreneurs, business owners that have built something up over time. They don't like the idea of selling pieces of their business, right, to fund their lifestyles, to pay for vacations, to pay for bills. They would much rather prefer a system that is generating income, a portfolio that is delivering them enough income each year to fund their goals, to fund their lifestyle, and they let the principal compound. They leave the principal alone. And the vast majority of advisors have not set up their clients with that type of account or with that type of program. The vast majority of advisors have said, hey, look, you can pull out 4% a year of your stocks. We're going to sell 4% of your portfolio every year, regardless of what the market's doing. Even if it's down 30%, we're still selling that 4%. And we're pretty sure that's going to last you the rest of your life. You don't know how long you're going to live. And you have to then watch the market each year and realize if the market's down, wow, we're selling a bigger piece of our portfolio that year than we had hoped for. So we just find that a lot of people are kind of stuffed into this 4% withdrawal plan when they really are not geared for it mentally. They would much rather let the principal compound, leave that amount to their heirs. That's kind of their legacy, and not slowly watch it degrade and go down over time. We structure their portfolios that are meant to continue compounding over time. We hate the idea of watching your balances slowly degrade as we sell off a little bit each year. We want to generate income. We are cash flow focused. We are cash flow forward. We want the productive assets that we've invested in to replace the income that we're leaving as we retire, or to replace the business that we're selling. That's how we think about investing. We think about replicating these productive assets that we've created in our career in retirement. We want to work with ambitious people that have big goals for not only their family, their children, their heirs, but also for charity. We want to see people do productive things with this wealth. It's not meant to just dwindle in a bank account. We want to see people flourish and do great things with their assets over time, and we can help them do that by compounding that wealth. There are a couple of programs or a couple of wealth advisors that also are insurance brokers that sell annuities, which is nice in theory. An annuity is an insurance program that basically you are putting up a certain amount of money, and then you're contractually guaranteed to get a certain amount of income from that money as long as you live. And that is a comforting thought versus selling your stock portfolio at 4% a year. It's meant to solve some of the problems that we're talking about, but the main problem is that your heirs get stiffed, right? Because what happens if you pass away 10 years earlier than you might have thought? Well, the insurance company is getting to keep a lot more of your money. So an annuity is something that sounds nice in theory, but is actually a financial product that really ends up benefiting the insurance broker a fair amount. There's big commissions involved, and it's not maximizing your wealth. It's kind of gimmicky in my view, versus a diversified investment plan that can deliver most of the same benefits of that income over time, where you're not having to worry about, once again, selling your stocks to fund your lifestyle. With an annuity, you're really putting a ton of faith in that insurance company. Are they going to be around in 20, 30 years to continue to pay your annuity payments? You're sending the money to them, right? So whereas the income approach to retirement, where you are living off the productive assets, the productive income that your portfolio is generating, you control all those assets. Those assets are in your account, in your name, and they're doing productive things for you. So, and that is a way to leave a lot more money as a legacy when you pass away to your heirs than giving the money to an insurance company via an annuity. Our sweet spot client is 2 to 20 million. And really, the 2 million is not set in stone. We often have people that are high income professionals. They're on the path to 2 million. But once you get to 2 million, you can start doing some more creative things with private assets to boost income, which is really the main benefit that we're delivering to clients, is structuring these portfolios to generate growing income over time that makes retirement and getting to a place of work optional a lot easier for people than watching this account hopefully grow in their brokerage account, but not feeling like they have access to it, not benefiting from it until some mystical retirement age 20 years from now. The benefit of working with us is really seeing that compounding growth in your income is the strategy that we're laser focused on. I think the biggest problem with the current model for financial advice is mostly the fact that AI is coming, and it is going to be easier and easier to get great financial plans and great financial advice from AI. And therefore, the vast majority of the value that some of these advisors are offering for this 1% or 1.5% is going to go away. It's going to be real time in your computer. It's going to be quick and it's going to be accurate, and it's going to replace a lot of the business values. We're going to go back to this universe where investment management actually matters again in driving outcomes, in compounding wealth, versus sitting down for 5 hours with a client, going through all their variables and giving them a 20-page plan that's going to be obsolete the second they leave that office. So fees are going to come down. The 1.5% fee is way overpriced relative to the other options that people have in the marketplace, with AI getting better and better each day. And especially when that fee is uncapped. When your wealth continues to grow 2, 5, 10, 50, what have you, and the advisor's fees keep compounding with that amount of wealth, I think that model is going to go away over time. And so I think today, really, the problem is trying to fit people into a vanilla program that no longer works as well as it did the last 30 years. I mean, enemy is a strong word, right? I don't think financial advisors are enemies today or will be in the future. I think they are doing their best. They are doing a good job for the vast majority of clients they serve. I think the problem is more inherent in the business model and the fee structure and what they're offering, the basic stuff that they're offering clients today, versus the new tools that are coming out and getting better with AI every day. is going to disrupt that model. They're so focused on giving financial plans that are obsolete the second that plan is printed out. And people can get much better plans by the second with AI. So the model needs to go to lower fees that are capped, that don't just keep growing to the sky for the same amount of service and work for their clients. The model is going to go to fees, broader investment choices, including private assets that can increase returns and lower volatility, so better outcomes for the clients at lower fees. I think that's where the business is going. That's where Evergreen has put a stake in the ground to deliver on that future. As of today, March 2026, you can ask the LLMs, you can ask Claude, ChatGPT, here's my profile, here's what I hope to accomplish with my financial future. Can you please lay out a detailed financial plan? And it's going to give you something that is almost as good as just about any financial planner can give you today. That's the least sophisticated that model is ever going to be. It's going to get better and better and better. So financial planning as just a service is becoming free, right? The financial advice industry started out as we do your stock picking. We do all of your investment management. It has, over the last 30 years, morphed into, we're going to put you in vanilla ETFs and bonds, and the real thing we focus on is the financial plan. So that's going away. Like, that's getting disrupted. Technology is making that advice and that intelligence free for everybody. So what's going to happen to this industry? Is it going to just go away? Well, no, because this investment part is actually the hard part, is actually staying the course and putting your money into the right investments for you and driving wealth and achieving outcomes is going to become more and more valuable, because you're not going to be able to get the same type of returns in stocks and bonds that you did over the last cycle. I don't think so. And so the fees need to get reduced because we're no longer doing because we're not going to be doing the same financial planning in this industry that advisors have been doing the last 10 years. It's going to be free. So fees need to come down. They need to be capped, because it doesn't really cost our business X more to deliver your investment portfolio, whether or not you give us 100 million or 10 million. It's not 10x the work. So fees need to come down and they need to be capped. And that's how we've designed our business. And that is the future of wealth management. There's something in there that was useful. Yeah, really, over the last 20 years, financial advisors have morphed from investment managers to salespeople, right? Because they are delivering very simple vanilla ETFs, bonds that you can just click. It's a model portfolio. Because that part of the business is simplified and they can hire planners to do the paperwork, it really is morphed into a sales business. And so the vast majority of wealth management firms are sales driven. And that's why they want to focus on repeatable programs for each of their clients. They don't want customization. They don't want private assets. They don't want to do a lot of tax strategy based on the client's individual situation, because that adds complexity. They want their salespeople to go out there and hit the pavement hard and bring in as much AUM as possible. They are asset gatherers that are delivering a very defined product. Whereas that doesn't work for a lot of business owners. They have complicated lives. They have a lot of assets. They want to replicate the income from their businesses, or they want to diversify from having all of their wealth and all of their income into one business and just putting them in stocks and bonds that don't add a lot of tax strategy is not going to be that helpful for that particular person. So yes, the financial advice world became a sales-driven industry, and I think that changes more and more each year as AI gets better and better at a large chunk of that service. I think that what I cringe when I hear kind of traditional financial advice is when it really focuses on budgeting and it focuses on, hey, we got to make sure that you're saving up for your retirement. I just don't think that's the best advice for most people from just a life standpoint. You don't want people sacrificing their healthy younger years, especially with younger children, even teenage children when they have them in the house, or they can go on great trips and they can implement, or they can have these wonderful memories. That's going to be way more valuable than saving an extra $15,000, $20,000 because it's, quote, off the financial plan. I think that is a horrible way to advise somebody, when the reality is that we're all going to be living longer. If you're working with smart, ambitious clients, they're going to have ways to generate more income than their parents did when their parents were 60. And so people tend to get a little too scared about what their retirement's going to look like. And we are very much focused on adding additional income streams from the investment portfolios that make people feel better about going on those vacations, about buying the second house if they really desperately want it, about paying for college for their kids, about living in the now versus panicking about 20 years if they're going to have enough money. Most people over-index on that fear, and the financial advice industry can lean into that fear because it's good for them. It's because what some of their financial planning software tells them to say, right? That's what the math might suggest if they're being very conservative about this stock bond portfolio. So yeah, I think that's the advice that rubs me the wrong way, is when people are sacrificing their golden years with their kids or their teenagers in order to save some money when they're 70, when they might not want to travel as much. So we want to focus on maximizing your life in every year, not just in your golden years. I just think we're in a new era. The game has changed. You can't get away with your father or your mother's retirement, where you put a certain amount of money into stocks and bonds and you just kind of bled that down over time. I think that the U.S. debt crisis has changed bonds, and they are not as investable as they once were, at least long bonds. There are a lot of other ways to set up your investment portfolio that drives income and can make you feel like work is optional versus a traditional golden watch retirement where you're selling down your stocks over time and you're ending with zero. We can add a lot of income streams over time that you can stack up and feel more empowered to make choices with your career, to retire early, to take on new projects, and to still compound your wealth over time. I feel like the financial industry is changing. It is ripe for disruption. Fees need to come down below 1%. They need to be capped above a certain amount of wealth. They shouldn't compound forever. Financial advisors want to put clients into very vanilla 60-40 stock and bond portfolios, and that is an investment profile that worked really well over the last 30 years. Given AI and given the amount of debt we have in this country and the Fed's willingness to keep printing and deflating away our currency, bonds are not going to work like they used to. They used to diversify a stock portfolio. They used to hedge. That doesn't work anymore. We need to find new hedges. We need to find new income sources from our investment portfolios to offset the volatility in down markets. So you need to look at more private market investments. A lot of wealth management firms today are leaning into, we provide financial plans. We provide holistic planning. They have the retirement couple walking on the beach. They're sailing, right? They are offering very cookie cutter advice, and they are charging a lot of fees that are uncapped for that advice. And they are pitching these financial plans that AI is going to do at a much faster rate in a much more robust way. And so that advice is now becoming free, and yet they are charging you a lot of money for it. And so the future of wealth management is setting up your particular investments to deliver the outcomes and the income that you need to last as long as you want while still compounding your wealth, and then layering in tax strategy on top of that. That is the new value and the new future of wealth management. It is not giving you a 20-page financial plan that your AI can do in a second much better and for free. All right, well, if you've made it this far and you're interested in what we've talked about here, we're going to have some resources for you down below. You can reach out to our team and we can talk about your individual investment portfolio.